This is FRM Part 1, Book 1, Foundations of Risk Management, and the chapter on multi-factor models of risk-adjusted asset returns. I bet you were thinking, hey, you know what, this CAPM is really cool. It tells us a lot about systematic risk and sensitivities, but this model relies on just one factor. Is it possible that there are multiple factors out there that affect financial asset returns? So this chapter could be called, yes, this is the next logical step from the single factor capital asset pricing model to multiple factors. So let's look at the learning objectives here. We're going to describe some inputs of these multi-factor models. What we're going to do is compute the expected return on a financial asset, just like we did back in the capital asset pricing model. We're going to rely on well-diversified portfolios. We're going to talk about hedging. And then we're going to look at a three-factor model, which was developed by two of the giants in the academic world of finance. Let's start with a multi-factor model. And let's go back and remind ourselves what that capital asset pricing model was. Remember, beta is the measure of systematic risk. Market portfolio has a beta of 1, so any stock that has a beta that exceeds 1 has greater systematic risk. Any stock that has a beta less than 1 has less systematic risk than the market portfolio. Now what that means is that if you own a stock that has a beta of 1.5, that means that you're going to have 50% more sensitivity to changes in economic information than the market portfolio. But what if that beta of 1.5 is a summary? It's an average of all of the economic information that's out there. I mean, let's face it, what kind of economic information affects stock prices? How about changes in the size of the economy? How about interest rates? How about exchange rates? How about oil prices? Is it fair to put all that pressure on the beta from the capital asset pricing model to capture all of those sensitivities? So what a multi-factor model does is it introduces uncertainty stemming from multiple sources. CAPM, on the other hand, relies on beta, which, as you should remember, is defined as the covariance between the individual stock and the market portfolio divided by the variance of the market portfolio. So just like with CAPM, we can calculate the expected return on an individual stock. We're going to do the same thing with multi-factor models, but instead of relying on just one factor, we can rely on multiple factors. Wow, how cool is that? And look at my bottom circle point there. I've got a couple of examples: inflation and interest rate, business cycle uncertainty. What else did I just say? Exchange rates, whether there's a Democrat or a Republican in the White House. All sorts of factors that will play a role in determining the rate of return that you can reasonably expect to get out of a share of stock or a portfolio of stocks. All right, so this is what a multi-factor model looks like. Notice the formula there. We've got the actual return on an individual security is equal to its expected return plus a bunch of other stuff. And look at that bunch of other stuff there to the right of the first plus sign. We've got an F1 and an F2. And remember that the plus sign with a bunch of dots following it, then another plus sign, that means that there could be an F3 and an F4 and an F5 all the way out to an FK. So those are the factors. Let me go back here. Whoops, I went the wrong way. Those are the factors at my bottom circle point: inflation and interest rates, etc. Okay? And then the betas, they work just like they did back in the capital asset pricing model. Notice my second bullet point at the top. It is a measure of the sensitivity of a given financial asset to a specific factor, to one of those factors like inflation or interest rates. Okay? Now, here's the thing. Those macroeconomic factors, those are surprise factors. All right, so if there are no economic surprises, in other words, if everything happens as investors expect, then all of those terms to the right of the plus sign, they go away, so that the return on an individual stock is equal to its expected return. All right, let's start with a single factor model. All right, so this model assumes there's just one macroeconomic factor. So the actual return on the stock is equal to its expected return plus some factor times its sensitivity. And so I want you to think of that beta as a measure of sensitivity to that particular factor. I think some examples will probably help here. So we've got this company, Blu-ray Limited. We have the expected return of 10%. We have a GDP factor beta of 1.5, and then an unexpected GDP growth of 4%. All right, so let's use this single factor model to compute the return on this individual stock. All right, now let's go back to the 1.5. What that means is this GDP factor beta means that we are 1.5 sensitive to changes, unexpected changes in the size of the economy. So really all we're going to do here is some simple math. We're going to take the expected return of 10% and then add the product of the sensitivity times the factor of 4%, and that gets us up to 16%. And by the way, that little e sub I there, that's an error term. That's a disturbance term from regression models, and that has an expected value of 0. And we'll just assume that that's 0 in this model. How about if we include another factor? So let's go to a two-factor model in which our BRL common stock is sensitive to changes in GDP and changes in interest rates. So we still have the same 10% expected return. We've got a GDP factor of 1.5. We have an interest rate factor of 2. All right, so let's make sure you understand what that means. That means that if the size of the economy grows unexpectedly, we're going to react 1.5. If the interest rates change by 2, if the interest rates change, we're going to react by 2. So does that make sense that we're going to react more strongly? We're going to be more sensitive to changes in interest rates than we are to changes in GDP. See how cool this model is? What it does is it allows you to determine how sensitive you are, an individual stock or a portfolio stock, to changes in relevant economic information out there. So we'll use that same 4% in GDP, and then we'll do 1%. So if we compute that return, we'll just do some simple math here. And so if this two-factor model is more appropriate to the common stock of BRL than the one-factor model, then we should have gotten 18% out of that. All right, let's move on to arbitrage. And to talk about arbitrage, we've got to spend some time on this law of one price. And I remember back hundreds of years ago when I was sitting in my first economics class, the professor asked us the question. He said something like, if you went downtown and bought a Big Mac, how much would you pay for it? And in 1981, I have no idea how much a Big Mac costs. Maybe it was 50 cents. And this professor then said, okay, suppose that you could transport yourself to some other country. How much would a Big Mac cost? You would take the 50 cents and you would exchange it for whatever currency that was the domestic currency of the country that you were visiting, and you would get a bunch of that foreign currency, and you could go to McDonald's and you would be able to buy a Big Mac. So a Big Mac here was a Big Mac there. And I remember thinking to myself, that's a really cool example and it has some good applications, but how am I going to transport myself to some foreign country without, like paying for an airplane and all that kind of stuff? So here's the point though. If in fact markets are integrated, then the law of one price has to hold. In other words, if there's a Philadelphia Stock Exchange and there's a Pittsburgh Stock Exchange, and they were both trading shares of IBM stock, that those shares of IBM stock ought to trade for the same price because, look, we can just get on our phone and click on Pittsburgh or click on Philadelphia and buy or sell in either market. So those have to be priced identically, and that's why I put the identically in bold there. All right, if this doesn't hold, then arbitrage exists. So let's define arbitrage. It's an opportunity that requires no investment and that you have to take no risk, but you can generate a positive return. That sounds like my children's lives. So notice my second bullet point. It refers to the action of buying an asset in the cheaper market and then simultaneously selling that in the more expensive market to make a risk-free profit. I mean, just use my Pittsburgh and Philadelphia example. We could buy at Pittsburgh for $100 and then sell it in the Philadelphia market for $110. But this is how financial markets work. Look, so you could make $10, and after you made $10, what would you do? You would probably go back and do it again. And so you would hit your phone, right? So the Pittsburgh people would be there. Hey, what is Jim doing? He's buying and buying and buying and buying and buying. There's that extra demand, right? There's the demand. So the price in Pittsburgh is going to rise. And then the people in Philadelphia are saying, what is Jim doing? He's selling, 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 selling. So the price has to fall. So they meet in the middle at, let's just pick a number, say 105. And though that's what these economists are telling us, that equilibrium exists between and among markets because they can actually see supply and demand. They can see Jim doing this over here in Pittsburgh and Jim doing this over here in Philadelphia. All right, let's talk about hedging here. Let's suppose that we have a portfolio manager who has the following factor betas. So GDP beta is 0.4, consumer sentiment beta is 0.2. And this portfolio manager or investor wants to hedge the GDP factor risk. Get rid of the sensitivity to GDP, which means that he or she wants his portfolio to be unaffected when there are surprises in the growth of the economy. However, there's a comma there. However, we want to still maintain the exposure to consumer sentiment. How would we do this? Well, this is really easy. What we're going to do is we're going to combine the original portfolio with a 40% short position in the GDP factor portfolio. So what we're doing is we've got the long in the original portfolio and the short in the new portfolio, and those things, they cancel each other. Gains in one portfolio offset the losses in another portfolio. How about if we want to do just the opposite? Let's suppose that we want to hedge the consumer sentiment, yet maintain the 0.4 exposure to GDP. Well, we're going to take the short position, 20%, whatever that means in terms of the value of the portfolio. We're going to take a 20% short position in consumer sentiment, and that's going to exactly offset. Now, in case one and case two, what we were trying to do is we were trying to eliminate it, right? Get down to zero. And that's probably not too practical, but what lots of portfolio managers like to do is they like to reduce that sensitivity for a shorter time period. I mean, one way they can do it is through derivatives, but another way they can do it is through this multi-factor model. And so suppose in this case here that instead of wanting to eliminate the consumer sentiment position, they only wanted to cut it in half. So you'd take a 10% short position. So you'd still have a little bit left, but you wouldn't have the entire 20%. Well, how about if you want to hedge both factor risks? What would be the motivation for this? You're thinking, oh my gosh, the economy is going to shrink and interest rates and inflation are going to completely skyrocket. And you think this is only going to happen over the short term. I mean, let's face it, if you thought this was going to happen for the long term, you'd probably sell the portfolio. All right, so what we're going to do is we're going to form another portfolio here. Let's refer to this portfolio as portfolio H, like the hedged portfolio. We're going to do 40% in the GDP factor, 20% in the consumer sentiment factor, and 40% in the risk-free portfolio. And then what we're going to do is we're just going to keep our original portfolio and then short portfolio H. So think about what that has. You have one portfolio that does this, and you have another portfolio that does just the opposite. So essentially, now don't tell your stats professors that I said this, but essentially you have two portfolios that have a negative correlation. Oh, do they have a -1 correlation? I mean, they could, but I don't know that they will, but something close to it. All right, this leads us then right into the arbitrage pricing theory, which was developed in 1976 by a dude named Stephen Ross. And what Ross did, I mean, he was the original here. This came before all the multiple factor models. He said the following. Now, remember, the capital asset pricing model was developed about 12 years prior to 1976. So Stephen Ross was thinking about this for a long time, and he thought, all right, what if there are other factors out there? Now, remember, in the capital asset pricing model, inside of that equation, there was the expected return on the market minus the risk-free rate of interest. And we all have come to know that that's called the market risk premium. And so Ross decided to use that concept of a market risk premium, but attach it to individual factors. So in the APT model, we're just calling these RPs, the risk premium. And so notice what we're doing here. We're trying to determine the expected return on an individual stock. It starts with the risk-free rate of interest, just like the capital asset pricing model, and then it identifies risk premiums. And there's an RP1, an RP2, an RP3. There's a bunch of dots there. So there's an RP of 4, an RP5, and an RP100, all the way out to an RPK. And then there are all of those individual betas. So those are sensitivities to those individual risk premiums, not factors, but risk premiums. I mean, the two are related. All right, so what does this mean, arbitrage pricing theory? Let's continue our discussion on these risk premiums. So what we're going to do is a couple of steps here. We're going to create well-diversified factor portfolios, where each portfolio has a beta of 1 for a single risk, like the market portfolio or GDP or interest rates, and then betas of 0 for the remaining factors. All right, that's called a well-diversified factor portfolio. And so you just continue to do this until all of the K factors are accounted for. All right, then you're going to derive returns for each factor portfolio, and then you're going to compute those risk premiums for each factor portfolio. All right, so once we can do this, then we can rewrite this. And so there's the expected return on an individual stock. Starts with the risk-free rate of interest, and then there's the I1 and beta I2 and beta I3. And there's the expected return on factor 1 minus the risk-free rate of interest. And so those are market risk premiums. Now, the problem with the APT is that it never really identifies which are the relevant risk premiums. Well-diversified portfolios can be formed according to the assumptions of the model. There are no arbitrage opportunities. Think of the Pittsburgh-Philadelphia example. And then the returns will follow a K-factor process. So once again, here's my last arrow point there on the bottom of the page, that CAPM has just one risk factor, but APT can have multiple risk factors. So let's take just a quick example here. We've got a risk-free rate, we've got some factor betas and a risk premium. So go ahead and compute this expected return on asset A. And so we'll just do some simple math there and we get 4%. Now let's go to what's kind of some unique midpoint between those multi-factor models that we started with and the arbitrage pricing theory that we just talked about here. Notice my first bullet point there. It's silent on the issue of the appropriate risk factors to use. So Fama and French, they came up with 3 factors. And this was really a fascinating article when it came out in the finance academic community. So we're relying on firm size, we're relying on book-to-market values, and we're relying on risk premiums, market risk premiums, just like we did back in the capital asset pricing model. So here are the factors there. We're going to start with this size. And so what this premium is, it's going to be the difference between the returns to small firms to the returns to big firms, because what was known then at some point, academic researchers found that small firms tend to outperform large firms, even in a risk-adjusted environment. And so this size persevered across all different sorts of sections of industries and companies. Book-to-market values also persisted these kinds of returns. Value, this is where we get the value stocks tend to outperform growth stocks. And then the excess return on the market portfolio. So notice my first circle point there, this argument that returns are higher on small firms and the returns are higher on high book to market firms, which is a value firm. It has been validated through historical analysis. And by the way, this is in lots and lots of finance academic journals. So Fama-French thought that maybe small firms are just riskier and that high book to market firms are undervalued. So the equation looks like that. The expected return on an individual stock is the risk-free rate of interest plus a sensitivity to the market risk premium. After all, we need to worry about what happens on the floor of the New York Stock Exchange. And the size effect, so there's the beta times the size, and then there's a beta times the high minus the low. And there's that error term in the back. Now, this intercept term can be defined as an abnormal performance of the asset after controlling for its exposure to the market and firm size and book to market factors. And that intercept term, of course, is the result of some regression analysis. And there's a good exam tip. If you're following size strategy, a size hedging strategy, you take the long position in the small firms because they're going to outperform, right? And short the big firms because they're going to underperform. And the same thing works with the value stocks. And I think that takes us to the end. Boy, we described the multi-factor, we did expected returns, we talked about the importance of well-diversified portfolios. We just did some hedging examples, and we had one in a previous slide, and there's the Fama-French 3-factor model. Okay.